Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
All right, $6.60. That is the closing price for POAS Technology Holdings, ticker POAS for today, Wednesday, February 4th, 2026. Now, if you were watching the tape, you saw a single session move of $1.61. That's a massive 32.26% gain in just 6.5 hours. We saw, 1,356,741 shares change hands, pushing the market cap up to $190.29 million. We've just shattered the previous resistance levels. We hit a new 52-week high, and well, frankly, the market is finally waking up to what this company actually has.
Or the market is finally losing its mind. I mean, I'm looking at the exact same ticker, but I see a completely different reality. I'm seeing a company that generated $128,464 in revenue for the entire fiscal year of 2025. You are talking about a $190 million valuation for a business that brought in less money last year than a busy corner coffee shop does in a single month. This isn't a breakout. This is a valuation bubble, completely disconnected from financial gravity.
Well, that's the easy critique, right? Looking at backward-facing accounting metrics for a company that just secured its future. The question isn't what they sold yesterday when they were effectively broke and capital constrained. The question is this a justified breakout for a revolutionary microscopy company that has solved a century-old physics problem and finally has the cash to scale?
And my question is simpler. Is a 400 times price-to-sales ratio ever justified for a company with crumbling financials, doubled losses, and a dependency on a handful of customers? I don't care how good the microscope is if the business model is out of focus.
I see why you think that, but let's strip away the spreadsheet for just a minute and look at the asset. We really need to start with what PHAONS actually owns. This isn't just another hardware manufacturer making slightly better lenses. They have, effectively circumvented the AB diffraction limit.
Okay, we need to pause there. You're throwing around physics terms, but we need to understand the business implication. What is the AB limit?
It's the speed limit of optical physics. For over 100 years, traditional optical microscopy hit a hard wall at roughly 200 nanometers. Because of the wavelength of light, if two objects were closer than that, they just blurred into one blob. You couldn't distinguish them. If you wanted to see anything smaller, like the details of a virus or a defect on a silicon wafer, you had to abandon light and use electrons. You had to buy a scanning electron microscope, or SEM.
Right, which are standard in the industry. Canon, Nikon, they all make them. It's a solved problem.
But think about the cost of that standard. I mean, electron microscopes require these expensive vacuum chambers. You have to coat your samples in gold or carbon. It takes time, it takes a massive footprint, and crucially, you cannot look at live biological samples because the vacuum and electron beam will kill them instantly. You can't study life if you have to kill it just to see it.
Granted, SEMs are cumbersome, I will give you that.
PHAOS changes the game. Their profit comes from their proprietary microsphere technology. They use millions of these tiny, microscopic spheres to capture high-frequency light waves that usually decay before they ever hit the lens. They magnify the image before the lens even sees it. This allows for super-resolution imaging at a commercially viable working distance. No vacuum required, no gold coating. And this is key, it's dye-free. So if you are a biologist studying blood cells, you don't have to contaminate your sample with chemical fluorescent markers. This is a blue ocean technology.
I'm not disputing the physics. The science is fascinating. I get it. I'm disputing the ability to monetize that science. You mentioned commercial viability, but the numbers suggest the exact opposite. If this tech is so revolutionary, why was their revenue in a complete freefall?
Because of solvency, not technology. The only reason they haven't scaled yet was because they were running on fumes. They literally couldn't afford to build the units. The IPO in November fixed that. They raised $12.42 million. That is the catalyst. The technology is ready, and now the bank account is too.
That's a compelling narrative, sure. But have you considered the hole they are digging themselves out of? Let's look at the financial reality here. You mentioned the IPO raised $12 million. Great. They needed it because before that, they had less than $100,000 in cash. They were, for all intents and purposes, insolvent.
Startups often run lean. That is just the nature of the beast.
There is lean, and then there is collapsed. In fiscal 2025, their revenue didn't just dip, it evaporated by 91%. They went from over $1 million in sales in 2024 to roughly $128,000 in 2025. Meanwhile, their net losses doubled to $3.93 million. You are paying a premium for a company that is technically in survival mode, not growth mode.
It was survival mode, past tense. That revenue drop you're fixating on, that was directly caused by the cash crunch. They couldn't pay suppliers to get the parts to build the microscopes to fulfill the orders. It was a supply chain freeze, not a lack of demand. Now that they have the cash, that freeze is over.
Is it, though? The market is pricing this at nearly $200 million. That is just irrational exuberance driven by a low float, meaning there aren't many shares available to trade, and pure retail momentum, likely sparked by today's volume. When you have a company trading at these multiples with that kind of revenue collapse, you aren't investing. You're just gambling that they can rebuild an entire business from scratch before that $12 million runs out.
Well, I'm not convinced by that line of reasoning, because you are valuing a tech startup like a mature industrial firm. Let's dig into the valuation, because I know that's your biggest sticking point.
It certainly is. Let's talk about the price-to-sales ratio, or PS. This is the metric of how much you are paying for every dollar the company brings in. As I mentioned, Fales is trading at nearly 400 times its trailing 12-month sales. 400x.
Which is high, I admit, if you're only looking at the trailing 12 months.
High? It's astronomical. Let's just look at a peer for sanity's sake. Coda Octopus Group, ticker CODA. They are in the specialty instrumentation space. Market cap around $113 million, so actually smaller than POAS is today. Coda is profitable, they have real revenue, and they trade at 4.6 times sales. So you have POAS at 400 times and a profitable peer at 4.6. Even if POAS recovers to its 2024 revenue levels of $1.38 million, you are still paying a massive premium.
Comparing POAS to Coda Octopus is apples to oranges. POAS is a disruptive tech play. Coda is a steady-state business. The market rewards potential. A better comparison is what Files is trying to disrupt. Look at Keyence or Nikon.
Keyence generates over $7 billion in revenue and has a 50% operating margin. They have global service networks. If a Keyence microscope breaks in Berlin, a technician is there the next day. POAS has negative 19% gross margins and relies on third-party distributors. You cannot compare a mouse to an elephant and say the mouse is worth more because it might grow into a Godzilla.
But the market looks forward, not backward. Why did the stock break resistance at 344 and 353? Why did the technical indicators shift to strong buy? It's because the market realizes that the revenue collapse in 2025 was an anomaly caused by a lack of working capital. That roadblock is gone. You are paying for the moat. They can do what a scanning electron microscope does, but cheaper and faster. If they capture even 1% of the semiconductor failure analysis market, a market worth billions, that $190 million valuation will look cheap.
Sure, the RSI and the MACD are screaming upward momentum right now, but that also puts them deep into overbought territory. We saw a 32% move today. In my experience, when a microcap with no institutional backing goes parabolic like this, a mean reversion is usually right around the corner. Gravity always wins.
Or it's a breakout. But let's move to the business model, because you seem to think they don't have one. It's not just one microscope. They have the Opto Nano series, which is the flagship for universities. They have the PT Industrial for failure analysis, and they just launched the PT Biology series in Q2 2023. They are diversifying.
Diversifying product lines doesn't matter if you don't have any customers.
They are getting customers. And there is an AI angle here you are ignoring. POAS isn't just selling hardware. They are integrating software that constructs these super-resolution images. That is potential recurring revenue. Plus, look at the news from January 2026. They are expanding strategically into Vietnam, the Philippines, and Indonesia.
I'm sorry, but I just don't buy that expansion as a pure positive. Let's talk about what that expansion actually signals. To me, It looks like a desperate attempt to fix a massive vulnerability. Concentration risk.
It's strategic diversification into manufacturing hubs.
It's an existential threat. Look at their filings. 5 customers accounted for 85% of their revenue. 5. If 2 of them decide to switch to Nikon, POAS is finished. And it's not just customers. 5 suppliers account for 85% of their cost of goods sold. They have 0 pricing power. If a supplier raises prices, POAS eats it. If a customer demands a discount, POAS given it. Now they want to take their limited $12 million cash pile and burn it, opening sales offices in 3 different countries?
They have to. That's how you fix the concentration risk. Moving away from distributors to direct sales in Vietnam is exactly the right move. That's where the semiconductor packaging facilities are. That's where the demand for the PT Industrial series is. By going direct, they capture the margin that distributors were taking. They stop paying a middleman and keep that profit. It is a margin play as much as a volume play.
Or they increase their burn rate significantly while revenue is still a trickle. Building a direct sales force is expensive. You have salaries, office leases, travel, compliance costs in 3 different jurisdictions. They have a runway of maybe, 3.8 years at the current burn rate. If they start spending aggressively on expansion before revenue returns, that runway shrinks to 18 months very, very quickly. They are betting the farm on this expansion working immediately.
You have to spend money to make money, and they have the leadership to do it.
Do they? Let's talk about the people running the ship, because when I look at the governance, I see red flags everywhere.
I see commitment.
I see a dual-class share structure. Bae Hook Sang, the executive chairman, controls 62.4% of the vote. Public shareholders, the people buying at $6.60 today, have absolutely 0 say in how this company is run. It is a controlled company. If Mr. Bae wants to pivot the company to making toaster ovens tomorrow, he can, and you can't stop him.
That structure is common in tech. Google has it. Meta has it. It protects the vision from short-term thinking.
POAS is not Google. And look at the board turnover. A bunch of new directors joined around the IPO and then resigned by December 31st, 2025. That kind of revolving door usually signals internal conflict. People don't jump off a ship that they think is sailing toward victory.
Or it signals the transition from a private startup to a public company. That happens. But look at the CEO, Andrew Yu. You want to talk about reputable? This man personally guaranteed a bank loan at 7.75% interest to keep the company alive before the IPO. He put his own credit, his own assets on the line. That is skin in the game. That is a leader who believes in the mission.
It's commendable, sure. It shows he believes. But it also highlights how desperate the situation was. A CEO shouldn't have to personally guarantee loans if the business is healthy. And let's not forget the impairment charge. There was a $937,284 impairment on a loan to a partner, PT Nora Integrity Solutions. That is nearly $1 million of shareholder capital that just evaporated on a bad financial bet. That doesn't scream prudent capital allocation to me.
Mistakes happen in early-stage companies. The key is that there has been no significant insider selling post-IPO. We are sitting at a new high, 660, and the insiders aren't dumping shares. They are holding. That tells me they believe the valuation is going higher.
Or they are locked up by IPO agreements. But more importantly, look at the institutional ownership. It is effectively 0. There are no 13F filings. The smart money, the pension funds, the hedge funds, the endowments, they aren't touching this. This rally is purely retail. And when retail momentum fades, there is no institutional floor to catch the stock.
Institutional money is slow. They wait for quarters of data. Individual investors have the advantage here of getting in before the institutions validate the turnaround. That is where the alpha is generated.
Or they have the disadvantage of holding the bag when the hype evaporates.
All right, let's make this practical for our listeners. We always like to break down an investment scenario. Let's say a listener decides to put $5,000 into POAS at today's closing price of $6.60. That gets them roughly 757 shares.
A bold move. Let's see how it plays out in the wallet.
In the short term, say the next 1 to 3 months, this is a momentum play.
The technicals are strong, volume is huge at 1.3 million shares. I see retail enthusiasm pushing this to $8. The float is low, so buying pressure moves the price fast. Your $5,000 becomes $6,056. That's a quick 21% gain.
I come at it from a different angle. We just had a 32% jump in one day. The RSI is overheated. I see a mean reversion. The traders who bought at $3 are going to take profits. The stock slides back down to its IPO support level of $4. Your $5,000 investment drops to $3,028. You've lost 39% of your capital in a month because you bought the top of a hype cycle.
That's the bear case. But look at the midterm, 6 to 18 months. This is the execution play. If Andrew Yeo and the team use that IPO cash to get the Vietnam and Philippine offices running, and they secured just a few large industrial contracts for semiconductor inspection, revenue could restore to $1.5 million. If they show growth in the AI software side, the market will award them a higher multiple closer to high-growth tech. I could see a price target of $10. Now your portfolio is sitting at $7,570. You're up 51%.
That assumes flawless execution. My midterm scenario is the reality check. They burn through half that cash pile trying to expand. Revenue stays stubborn under $500,000 because the sales cycle for industrial equipment is long. Companies don't switch microscopes overnight. The market realizes the growth isn't instant. The stock retests its all-time low of $2.90. Your $5,000 is now worth $2,195. You are down 56% and holding a mesmerizingly illiquid stock that you might not be able to sell easily.
You're very pessimistic today. Let's look at the long term, 3 to 5 years. This is where the physics wins.
Or fails.
The binary outcome. My view. POAS proves their microsphere technology is the new standard for semiconductor failure analysis. They become an acquisition target. Keyence or Nikon decides it's cheaper to buy them than to compete with them. A buyout at $20 plus isn't unreasonable for proprietary tech like this. Your $5,000 turns into $15,140, a 202% return. That is why you take the risk.
And my long-term view is unfortunately binary in the other direction. Insolvency. Great science does not always make a great business. If they can't commercialize this at scale before the money runs out, and if they can't break that customer concentration, they face bankruptcy or delisting. In that case, your $5,000 goes to zero. It's a total loss.
That is the risk profile of high-tech microcaps. But looking at today's action, I think the market is voting for the turnaround.
The market votes every day, and today it voted with euphoria.
So, to summarize my position, POAS Technology Holdings is a high-risk, high-reward play on hard science. You are buying a piece of technology that breaks physical barriers. The price action today confirms that the market is finally valuing that IP, now that the bankruptcy risk is off the table. The management has skin in the game, and the expansion plan into Southeast Asia is the right strategic move to capture high-margin direct sales.
And to summarize my view, this is a survival stock being priced like a hyper-growth unicorn. The fundamentals: negative margins, tiny revenue, massive concentration risk, do not support a $190 million valuation. The 400 times PS ratio is a warning siren. This is a speculative instrument for the highest risk portion of a portfolio only. You are betting against gravity.
We can agree on one thing. The next quarterly revenue report will be the moment of truth.
Absolutely. We need to see if that IPO lifeline converts into actual sales dollars.
Until then, you have to decide if you are buying a physics breakthrough
Or a financial breakdown.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.